morning and a happy Friday from our global headquarters in New York. I'm Danny Berger, Manish Cranny on assignment this morning. Welcome to Bloomberg Brief. Let's set your agenda. Rate uncertainties. Fed's Wu Silverman backs modestly restrictive policy. Bostic says his economic outlook may change in just 6 months' time. Ready to step in, China vows to boost its service sector. Governor Ueda warns the BOJ can intervene to quell the latest surge in yields. And Washington and Kyiv talk over a mineral deal in stalemate as tensions remain high. Well, we've fallen back from the all-time highs. We managed to reach 2 in the past week. We're a little change this morning on your S&P 500 futures. NASDAQ 100 futures lead the charge higher. That compares to what's happening in China tech. Take a look at the bottom of your screen. 6.5% move higher thanks to Alibaba. Those earnings were good. One more earnings poor. That really seemed to be what set risk off yesterday. When it comes to bonds, U.S. Treasuries, yields declined rather yesterday. The decline continues today, down about a basis point. We're under 4.5% for your 10-year yield. Scott Besson telling the Bloomberg surveillance team that moves to term out the debt were a long way away. The bond market like what it heard. Gold is weaker this morning, but it is trading just around a record high, just under $3,000. Investment banking houses around the world upping their calls for the price levels of gold this morning. So that's a look at the overall picture for markets. Let's take a look at some of the individual stocks on the move. As I mentioned, Alibaba rising. If we take a look at its ADRs in the U.S., up 3.7%. It reported the fastest pace of revenue growth in over a year, driven by strong gains in e-commerce and cloud services. Also keeping an eye on Standard Chartered this morning. It hit its highest level in more than a decade. Shares up 4% in the London trade. The firm's buyback and dividend both came in higher than expected. Rounding things out with Rivian in the pre-market, shares are falling 2.2%. The EV maker issued a downbeat first quarter vehicle delivery forecast. That miss did overshadow its first ever quarterly profit. And just in a few moments, we're going to catch up with Laura Cooper of Nuveen. Later this hour, we'll talk stocks, we'll talk derivatives and options with Wu Silverman of RBC Capital Markets. So as I mentioned, longer end treasuries, they are continuing to modestly gain after Secretary Scott Besson spoke to Bloomberg on whether boosting the issuance of longer term notes is in the future.
That's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
I'm pleased to say that joining us now is Laura Cooper, global investment strategist and head of macro credit at Nuveen. Laura, great to see you as always. Since the start of this year, long-end bonds, that is 10-year yields, are lower by about 9 basis points this year. The call had been for more tension, maybe more inflation because of tariffs. That hasn't played out. But I wonder what to you is the bigger driver for bonds at this point. Is it what we hear from Scott Besson? Is it the technical structure of issuance of bonds? Or do you think we're starting to see some growth concerns creep into the long end?
I think what we're starting to see is some of those growth concerns come into the long end. I mean, if we think about what the market moves have been really since the September 50 basis point cut from the Fed, about 70 basis points of that move alone were driven by the term premium. So that largely captured a lot of the fiscal uncertainty. And then we've also seen a significant move in break-evens, and that's capturing the inflation expectations climbing higher. So that could arguably be already baked into the price. And so now we're shifting to other factors of the backdrop, and it's one of the reasons why we continue to be quite cautious on duration and see range-bound trading for that U.S. 10-year from here.
Can that cautiousness prevail, Laura, at the same time that equity markets hit new highs? Because if it's growth concerns that's moving bonds, shouldn't the same be said of equities?
That's a great question. I mean, I think when we think about what our outlook is for the bond market, it's not necessarily that we're going to see a significant catalyst that would spark a rally in the Treasury yields. Instead, it's really just this lack of conviction on a direction either way, in sense of what will the inflation impulse be from these new U.S. policies coming through, and what could the knock-on implications of growth and even the potential issuance that we could see change later this year. There's not a clear direction for Treasuries. Whereas for equities, we're clearly seeing the earnings picture. Yes, it has been quite mixed, but again, the liquidity backdrop is so ample that we're not necessarily seeing that similar type of growth catalyst to prompt a sharp drawdown.
What would be the catalyst to break bonds out of a range, to kind of shake us from this, I guess not complacency, but as you kind of framed it, this unknowingness? We have a lot of tariff deadlines soon approaching at the end of this month, or the start of March and the start of April. Is that the catalyst that this bond market needs? Because for now, it's really shrugged at any sort of tariff news.
Well, and what I think what's been interesting is if we think about the general thrust of the Fed speak that we've had over the past couple of days, it really does just capture this heightened degree of uncertainty, predominantly around the inflationary effect of some of these policies coming through. So we would probably need to see consecutive months of upside inflation surprises, building on that upside surprise that we saw more recently, for the Fed to become even more cautious. They are data dependent. And if there's a signal that they're going to have to keep rates in even more of a restrictive territory for further. I mean, we're still penciling in a cut in September, potentially another one in December. If those start to get pared back on those inflation expectations, then perhaps that's when we could see more of that negative downside to break treasuries from their current trading range.
To that point, Bostic saying yesterday, there's a decent chance that my outlook today is not going to be the same as it is 6 months from now. That underscoring just how much uncertainty there is. But Laura, we're coming out of this period where there's been extreme sensitivity to inflation on the part of central bankers, understandingly so, considering they kind of missed and said the whole transitory thing. It wasn't so transitory. But if we are going for an environment where both growth is under pressure and there are inflation concerns because of tariffs, what do you expect the reaction function of the central bank to be?
And I think what we're seeing is this divergence in the outlook on the inflation and growth backdrop from the U.S. in terms of what we're seeing in Europe and the U.K. You know, we still have a fairly favorable growth backdrop for this year, let's say real GDP around that 2% mark, whereas in Europe, the growth risks are clearly tilted to the downside. There's less conviction, I would say, from policymakers that we're going to get back to that 2% inflation target, certainly in any time soon. And then even in the U.K., we are continuing to see the stagflationary environment coming to the forefront. And so from a central bank perspective, will they actually have to keep rates on pause a little bit longer? That's not necessarily our base case. We still think both the Bank of England and ECB will have to cut rates quite aggressively in the second half of the year. And it's one of the reasons why we've been positioned in duration in those exposures rather than taking on U.S. rates.
And then it gets back to this irony, but this time in the Europe markets when it comes to equities in Europe hitting an all-time high on Tuesday. Laura, is that a trend you'd want to follow or push back against?
We had been getting more comfortable with European equities from a valuation standpoint, but if we look at the price action year to date, we have the benign tariff backdrop feeding in. We have the potential for a peace accord between Russia and Ukraine. There is also this fiscal impulse being priced in from a potential new German government. All of those three pillars, I think, are still on shaky ground. We don't have strong conviction that European equities can continue to advance, certainly at the pace that they have been. So we're a bit more cautious, and that largely reflects a lack of clarity on what the tariffs could actually be for Europe. We think that's going to have a more negative growth impulse coming through, and so it's important to be more selective in those European equity exposures rather than taking on broad benchmarks from a valuation standpoint.
Laura, is there any signal to be gleaned from German elections this weekend? How important is the outlook for that when it comes to things like this European bond market and equity market?
I think it's crucial when we think about the potential for debt reform coming through. I mean, markets are certainly pricing in the expectation that we could see more fiscal stimulus coming through. If we do see those fiscal levers being able to actually be used in the future, I think markets are getting a bit ahead of themselves, actually, because even if we see a two-party or three-party ruling coalition that will lead to that revision of that debt brake, we're not going to see any meaningful fiscal impulse, probably until later this year, but it's mostly going to be a 2026 story. And even then, we see an incremental change, at most 1% of GDP. So not really enough to materially change the outlook. And it's one of the reasons why we still think German bonds are quite attractive at these levels.
Yeah, and fair enough. Even Macron talking about the need for more defense spending, Laura. He's talking in a 5 to 10 year time frame. It's really just emphasizing what you say, that it's not going to be an immediate boost. Laura, I'm afraid that's all we have time for. Thanks so much for joining us. Laura Cooper of Nuveen. And just a programming note, we are going to be catching up with Oliver Crook in Germany in the next half hour to speak about the German elections. Now to other top stories that are trending on the terminal this morning. UK retail sales grew 1.7% in January. That is an exceeding of expectations. The rise was driven by consumers that spent more on food to eat at home. Food sales were the strongest since the start of the pandemic in March 2020. But consumers do remain cautious with decreases in other categories and weak consumer confidence. Meanwhile, in China, officials are mapping out plans for tapping the nation's huge customer base. This comes as Treasury Secretary Scott Bessent prepares to refresh calls for Beijing to decrease its dependence on exports. The Chinese premier urged to improve the supply of services in several industries, but didn't elaborate. Officials are expecting to set an ambitious growth goal of around 5% for this year. BOJ Governor Ueda warned that he was prepared to intervene in the bond market to stifle a surge in yields. He reiterated the central bank's commitment to supporting stability, though he did give little hint on whether any bond action might take place in the near term. Ueda's comments led to a fall in yields and a weakening of the yen. Now, as I mentioned, coming up on the show, Germany heads to the polls. We are live in Berlin with the latest on your Bloomberg Brief.
He needs to come back to the table, and we're going to continue to have discussions about where that deal is going. Again, we have an obligation to the taxpayer. I think this is an opportunity. The president thinks this is an opportunity for Ukraine going forward. There can be, in my view, nothing better for Ukraine's future and for their security than to have the United States invested in their prosperity long term.
That was U.S. National Security Advisor Mike Waltz calling on Ukraine's President Zelensky to come back to the table and work with the U.S. on a deal with Russia. The deal includes what happens with the country's minerals. Axios reporting that the Trump administration has offered Kyiv an improved draft for minerals agreement between the nations. Joining us for more is Bloomberg opinion writer Mark Champion. Mark, this was a deal that Zelensky seemingly rejected. There had been reporting that he was kind of thrust upon it during the Munich Security Conference, and it didn't have enough security guarantees for Ukraine. What do we understand about what this deal is actually about and what is being offered to President Zelensky?
Right. Well, so very briefly, the first thing is that this is an idea that was first put forward by Zelensky, who was thinking of basically how can I interest Donald Trump in engaging and trying to get a decent deal for Ukraine and providing security guarantees. So it was his idea. But the deal that was presented to him, from what we know of it, was it was more like, the kind of thing that you would impose on a country that is defeated as war reparations. President Trump made it very clear that he saw this as recompense for money that the U.S. has spent. And then what the deal really did was to say, we're going to set up a fund. The U.S. will own 50%. And 50% of all revenues in perpetuity from all of Ukraine's, mineral resources, infrastructure, ports, etc., would go to the U.S. Within that deal was the part was missing that Ukraine had, proposed it for, which was the security guarantees, any idea of what the U.S. would do for them. So Zelensky rejected it. Now we have apparently, an improved deal. He seems to be more open to that. We don't really know the precise details of the new deal, other than the jurisdiction for the deal, it seems, is no longer extraterritorial, no longer in New York.
Mark, it gets to this other matter in terms of what the motives are behind what the Trump administration is doing. Is it to bring in end to the war in Ukraine, or is it to improve the U.S.'s position? And this brings us to what's happening in Russia. Treasury Secretary Scott Bessent yesterday on Bloomberg saying that there could be more imposition of sanctions or use of sanctions as a tool in this war in Ukraine. But we also heard from Marco Rubio after his meeting with Russian counterparts, continually bringing up this idea of economic opportunity in Russia. So how is the U.S. viewing sanctions as a tool to remove them, to improve the U.S. economic relationship with Russia, or as a cudgel to end the war in Ukraine?
Right. Well, I mean, it seems clear that the administration sees sanctions, lifting them or imposing some more, as leverage with Moscow. It's something, big they can offer, lifting sanctions. The threat from increasing sanctions is, it's less clear how big that is, given that mainly the U.S. has been talking about sanctioning trade between Russia and the U.S., which is, almost is minuscule. But nevertheless, they clearly see that as leverage. The question really is, what is the priority here? And if you look at what the U.S. has been doing, it seems fairly clear that the priority is that they want to get a reset with Russia. They want that to bring, economic benefit to the U.S. And they are less concerned about, getting the best possible deal for Ukraine, or for that matter, for involving Europe. So that this is where the concern has arisen. There's no problem with putting sanctions on the table. That's obviously, they were imposed over the war. It's obviously leverage if you want to end the war. But the discussion has been really, to put sanctions. Rubio was talking about, sanctions and the possibility of lifting sanctions to get this wider deal. And ending the war is a sort of, another tool in those negotiations, sine qua non, really, but maybe not the first priority.
Mark, we always really appreciate your time and your thoughts. That is Mark Champion from Bloomberg Opinion. Now, staying in Europe, Germans head to the polls this Sunday. German Chancellor Olaf Scholz has struggled in that. Elon Musk has also waded into the debate to support the AfD. And Vice President J.D. Vance's words in Munich last week still looming large over the continent. Bloomberg's Oliver Crook is outside the Chancellery in Berlin for us tracking the election. So we have 2 days to go until the polls. Oliver, what's at stake? What does it look like?
Yeah, Danny, I mean, this is a journey that really began on November the 5th when Olaf Scholz pulled the plug on his government, the fractious sort of coalition that he had been holding on to for a little while, and then eventually pulled the plug because they just couldn't agree. They couldn't find a budget. They couldn't basically decide how to spend the money in the next year. And that, of course, Danny, was the same day that Donald Trump was elected president of the United States. And that has turned out to be a fairly fateful date for the German economy and indeed for the continent of Europe. Looking into this weekend, what has been sort of remarkable throughout what this has been a very long election campaign for a snap election, Danny, is that basically the polls have not moved, right? The CDU, Friedrich Merz's party, Angela Merkel's traditional party, has been leading with 30%. But the other sort of main feature of this election campaign that makes it different from ones of the past is the existence of the AfD as having a chancellor candidate for the very first time. They're getting about 20% of the vote. And as you mentioned, Danny, another sort of new feature of this election is the degree to which another country and the United States has been wading into domestic politics in Germany. This is something that is really without precedent and something that really sort of caught everyone's attention last weekend at the Munich Security Conference when J.D. Vance was being intensely critical of basically mainstream political parties here in Germany and taking a meeting with the AfD head Alice Weidel instead of Olaf Scholz. So heading into the polls here, what we're expecting is the CDU to win. But again, Danny, anecdotally and also according to the data, a lot of the people you speak to in Germany to this day, 2 days away, do not know who they're going to vote for. That could throw up something very interesting on Sunday.
Oliver, to that point, it's in a period of fractious times for Europe, given what the U.S. has done, given the threat of tariffs and putting defense solely on the shoulders of Europe. We have a weakened Macron in France. Is there a situation where you get real leadership coming out of Germany, or is what you're describing in the polls, again, a continued vacuum in the largest economy in Europe?
Yeah, so listen, Danny, there's something really interesting here because I think that Friedrich Merz potentially has all of the ingredients to not just become Chancellor of Germany, but become basically leader of Europe. That is, of course, not a formal role, but as you mentioned, there's a massive leadership vacuum within Europe at a time in which you really do need strong leadership. You need to face up against the economic threat of China. You need to face up against the economic, political, and whatever the threat it is that's coming from the United States. And Friedrich Merz potentially could be that person, particularly if he is willing to move, and this is a very difficult discussion on the question of joint debt at the European level to finance some of that defense spending. And again, you come to Brussels with that chip as German Chancellor, you have a huge amount of power, and that is the sort of path that potentially he could be paving. But again, Danny, if you see a really fractured situation here in Germany, you're going to get paralysis not only in Europe's biggest economy, but in Europe as a whole.
Oliver, we really appreciate it. Our thanks to Oliver Crook outside the German Chancellery. And don't miss Oliver and the team's special coverage of the German election this Sunday. That will start at 12 p.m. Eastern, 6 p.m. in Berlin. Coming up, Tesla may be coming to Nissan's rescue. We're going to have more on that story for you next. Let's take a look at the front pages this morning. First up on the Financial Times, reporting that a high-level Japanese group has drawn up plans to seek investment from Tesla to help aid Nissan. Sources say that the group believes the EV maker is interested in acquiring Nissan's plants in the U.S. Nissan shares jumped more than 12% on the news of that potential investment. Next up, the Washington Post has this, reporting that President Trump is expected to take control of the U.S. Postal Service. He's expected to issue an executive order as soon as this week to fire members of its governing board. And Axios reporting that the Trump administration has given Ukraine an improved draft for the minerals agreement. Sources say that Zelensky's aides have encouraged him to sign the updated proposal to avoid a further clash with Trump. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Rates uncertainty. The Fed's Wu Silverman backs modestly restrictive policy. Bostic says his economic outlook may change in 6 months. Ready to step in, China vows to boost its services sector. Governor Ueda warns the BOJ can intervene to quell the latest surge in yields. And Washington and Kyiv talk over a minerals deal in stalemate as tensions remain high. It's the Friday of a holiday-shortened week, and we fell back from record all-time highs yesterday. We're attempting to claw something back today. We're a little changed, though, on S&P 500 futures. NASDAQ, Russell, those are up a bit more. But it is tech in Asia that's really the standout. The Hong Kong Tech Index closing at 6.5% higher with strong earnings from Alibaba. But yesterday, it was the weak earnings from Walmart, the concern on their forecast, weaker than expected, and consumer spending. Meanwhile, U.S. Treasury yields are declining this morning, down, let's call it 2 basis points if we're going to round up for your 10-year yield. We are below 4.49%. Scott Besson aiding this bond market yesterday, saying that it would be some time until they term out the debt. Gold, meanwhile, takes a notch lower from reaching all-time highs. $2,929 an ounce is where gold stands this morning. So stocks did retreat after 2 consecutive record highs for this year. RBC's Wu Silverman weighs in on the recent strength in equities, writing, quote, "In the past few weeks, we have seen a meaningful shift in the vibe from investors. In fact, there appears to be a clear disconnect between what the market is actually doing, i.e. reaching highs, and how investors feel. Very cautious." Amy joins us now. Amy is head of derivatives strategy at RBC Capital Markets. Amy, so wonderful to have you. And I think this quote is perfect for the time we're in because there's so much uncertainty, yet all-time highs. Just that break in sentiment versus positioning. What does that mean? How prepared this market is when it comes to hedges? Should things turn more sour?
Well, good morning. Look, I don't want to say there isn't hedging. There certainly is some, especially if you look from year on year last year to this year. Hedging levels have increased. There is more cautiousness in the market. But at the same time, when you think about headline VIX, where it is, Danny, folks still kind of seem kind of sanguine. And this conundrum, I've just been calling it the paddling duck market. I know I brought that up before, but it's just this idea that, this market continues to look calm and smooth on the surface. A lot of these violent rotations are furiously paddling underneath. You actually even see it in the Mag 7, Danny, where, half the names are doing well, the other half aren't, but you keep getting this cancellation on the index level.
Yeah, Amy, I believe last time you were on, you said the paddling duck could fall down a waterfall, which made us all very sad for the paddling duck.
Poor duck.
The poor duck. Do you think there's some degree where we're just too sanguine about this idea of a President Trump put? Do you think that's what's behind this market's ability to continue to be a paddling duck and look calm on the surface?
Yeah, look, this is completely anecdotally, but one thing I've heard as a refrain, it's just this chorus from investors since last year, is that Donald Trump is going to manage the stock market. He views it as a gauge of his success. He doesn't want it to go down. And, he'll consider that when thinking about implementation. And we were just speaking with investors in Toronto last week, and I can really tell you that tone has shifted. And the questioning of whether or not that is true, I think, is coming to the forefront. So that's why you're seeing this bubbling of cautiousness. The other thing I would say is, we're kind of heading to levels both in terms of volatility and the market where it doesn't take that much. We just need kind of a pickup in correlation. We've had this very high dispersion environment to really trigger something that could be a lot worse, which is why I think folks are, I'll call it hedging curious in a way they haven't been before.
Hedging curious. I love that, Amy. I mean, where it makes sense, though, to hedge at this moment? There was a point in time where you could say maybe your Mag 7 could be something of a safety trade. As you mentioned, that's not playing out as is. The VIX looks pretty calm at this point. What hedges will actually pay off and won't just be throwing money into a fire at this point?
And that I would say is what I spend the bulk of my day job thinking about, meaning, you can say hedge all you want, but it's got to be an effective hedge, because you think back to years like 2022 where hedges really didn't work and you still got a market drawdown. And that's a really tough place to be if you're a CIO or a CRO. So, two suggestions here. One is that I actually think traditional hedges, which haven't worked that well in the past, so your S&P puts or your VIX calls, they actually could do better, Danny, if you just believe that we're going to kind of get away from this very high dispersion environment. So correlations could pick up. That obviously fuels your volatility factor. I think that could happen just because of a lot of the intercorrelated macro risks. The second is you have to be very idiosyncratic. So whatever your positions are as a portfolio manager, think about doing those single stock hedges versus necessarily looking at the index level.
Amy, one thing that you write about that I find really interesting is the comparison between the melt-up in the markets now versus the post-COVID environment. This idea that after COVID, as you write, that you had to participate in the market, the kind of FOMO melt-up, the Mag 7 dominating things. How different is that narrative this time around? Is there still this idea that you have to participate, that you're going to miss it if you don't?
An interesting thing is I think retail still has that memo when you think about where the flows are and you think about the pockets of the market they're investing in. The second aspect I would say of this is there is this issue, because investors have kind of learned this post-COVID, that if you're not in the weightiest names, then you're going to drag your benchmark, and you cannot afford to do that. So structurally, we haven't talked about this, but one thing I think is interesting is you have a lot of folks who are long, and so they're essentially selling volatility as a way to harvest incremental yield and essentially saying, maybe we're going to grind from here. That's another reason you're getting the suppression in the volatility complex. And again, a trigger and correlation could change that. It wouldn't take much. But, I do think people have learned to jump in the pool, to hold that right tail. That's been much more the story of these past 4 years. It's hard to shake that story, Danny.
Well, when it comes to catalysts that could shake the story, Amy, how important is 5 days from now, February 26th, when we get NVIDIA earnings?
I think I put in the notes that NVIDIA is the OG of this entire AI trade. I stand by that. Look, it's May 2023 at this point when it triggered this entire AI thematic run that we've had that continues to be so important to not only the AI names specifically, but the AI adjacent names. You just can't discount how important one single name can be, not only because of its weight, but because of the complex that it supports. So I think, when you look at earnings day volatility there, it probably is justified given how important that single name is.
So there's volatility on that day, Amy, but I wonder if any of the other tariff dates get to the level of event risk. You have auto and chip pharma tariffs due April 2nd. Reciprocal tariff, that investigation's also due early April. Before that, the steel and aluminum, that's due March 12th. And the 2-month delay to Canada and Mexico tariffs, that supposedly happens on March 4th. Do you think any of these events register with the market?
They certainly do. The feedback I get from investors is when you think about the tariffs and those dates, they often get pushed or they often get negotiated. So they're not a hard date in the sense that NVIDIA is a hard date. You know what's going to happen. You know you're going to get a data point. And that's been really difficult for investors to the point where, we've kind of seen investors say, we're going to take this reduction in tenor. We're not going to do anything until we absolutely know that this might be the day that something happens or doesn't happen. So you see a lot more of this 0-day to expiry trading as a way to manage that risk. Or you see the opposite, which is people just sitting on much longer tenors, understanding the carry that would cost, but just saying, like, I can't make some bet that it'll definitely be by April 8th, if not.
Yeah, and President Trump has perhaps conditioned us to believe that these negotiations happens and dates get moved. Amy, so great to have you on. Thank you for your time this morning. Enjoy the rest of your Friday and your weekend. Amy Wu Silverman of RBC Capital Markets. Let's get you some of the top stories now that are trending on the terminal this morning. Chinese officials are mapping out plans for tapping the nation's huge customer base. This comes as Treasury Secretary Besson prepares to refresh calls for Beijing to decrease its dependence on exports. The Chinese premier urged the improved supply of services in several industries, but did not elaborate. Officials are expected to set an ambitious growth goal of around 5% for 2025. Elsewhere in Japan, BOJ Governor Ueda warned that he was prepared to intervene in the bond market to stifle a surge in yields. He reiterated that the central bank's commitment to supporting stability, but gave little hint on whether any bond action might take place in the near term. Ueda's comments did lead to a fall in yields and a weakening of the yen. Finally, Standard Chartered said it would hand back $1.5 billion more to shareholders as it reported fourth quarter earnings that beat estimates. That was boosted by a strong performance of its trading and wealth business. The CFO spoke to Bloomberg's Anna Edwards earlier today.
First of all, let's remember that in terms of contribution to the top line, our net interest income contributes about 50%, and our non-net interest income contributes about another 50%. Non-net interest income has very strong engines of growth, up 20% last year, as we have just discussed. And in terms of net interest income, we have been building up our hedges, de-risking the delivery of net interest income, and I think that positions us well for this slightly more uncertain world.
Okay, so let's turn to the other part of that of the income stream and away from net interest margin and the other areas. One of the areas I want to ask you about is global markets and what you've managed to achieve there in the global markets business, getting a boost from some of the volatility in markets, it seems, traders doing well on that. And that's been a story across Wall Street, across lots of the banking sector. Thing is that sustainable in any way? Do you have any visibility on whether that kind of performance is sustainable?
So I think it's sustainable for us. And the reason is that our markets business, as we often like to point out, is a peculiar type of market business. Because we are a giant connector bank, really 75% of what we do in markets is helping our clients manage their exposures to foreign currency, interest rates, and other risks. That is very recurrent activity. When volatility then spikes, we add to it performance in helping them take advantage of those market dislocations. But the delivery of our financial markets numbers is highly de-risked once again by this attractive complexion of the business, and it's business that, by the way, grows well. We pointed out at Q3 at our last set of results that this part of the business grows at almost 10% per annum, and it's been doing so for 5 years.
The Standard Chartered CFO there. Coming up on the show, the U.S. wants Ukraine to accept its minerals deal. Axios reporting that they've improved the terms. We're going to have more on that next on your Bloomberg Brief.
I do have my first call with my Chinese counterpart tomorrow morning, so I look forward to a very productive discussion.
What's the first point you want to bring up?
That we want to work together, and as we said, a lot of the precursor ingredients from fentanyl originate in China, so we really want to put a stop to that very quickly.
That was U.S. Treasury Secretary speaking to Bloomberg Surveillance yesterday. President Trump also told reporters on Air Force One earlier this week that a deal between Washington and Beijing was possible, even as tariffs are being touted and a trade war talks abound. At the same time, China talking more about trying to turn their economy to consumption, something Scott Bessent and others in the Trump administration have advocated for. Joining us for more is Bloomberg's Kevin Whitelaw. Kevin, a lot for those two to talk through on a possible call. What might we expect?
Well, I think it's going to be an initial conversation and an exploration from both sides to understand what sort of the framework is here. And the question really is the Trump administration using these tariffs as a lever for a deal on fentanyl and trade and other things, or you've also seen the White House start to talk in recent days and weeks a little bit more about the revenue side of what could be generated from tariffs. And so ultimately, there's going to have to be a decision within the Trump administration itself about what really is it that they're trying to accomplish with all of these various threats. Are they looking for a bunch of short-term deals? Are they looking for something that is a longer-term, sort of more structural deal? Or are they actually looking for a way to boost government revenue that is simply means that tariffs are going to come in some fashion or another, whether the countries like it or not?
I got to be honest, Kevin, I feel like you could almost ask a similar, not exactly the same question, but a similar question when it comes to what the U.S. is doing with Russia and as it pertains to the war in Ukraine. Does it seem at this moment that the conversations happening with Russia, Scott Bessent yesterday also bringing up the potential use of sanctions for this war in Ukraine, something to extract economic gain for the U.S. and Russian relations, or really as a tool to help end and get the best deal possible in the war in Ukraine?
Well, that's right. And you're hearing it both with the Ukraine side as well as with the Russia side. So obviously, we've talked about the possibility of Trump has talked about trying to strike a deal with Ukraine on critical minerals. He has also floated the idea of essentially improving and softening relations with Russia. And so, yeah, again, the same thing is a question of how much of this is really aimed at simply trying to get a win, i.e. a ceasefire deal, something that Trump did campaign on and promise, saying that he could end the war in Ukraine, and how much of this is about sort of some kind of promise beyond that, whether it is related to Russia's various, mineral and energy resources, or whether it's actually about Ukraine's. And so, to some degree, Trump is shaking up the conversation. He's forcing both sides to take a negotiation more seriously than they might have otherwise. But what is he really looking for? I still think we're still trying to understand that, frankly.
And Kevin, just want to wrap it up because Senate Republicans do appear to have adopted a narrower budget proposal after the vote-a-rama of last night going into the early hours of this morning. Democrats really attempting to pin Republicans down on certain votes, hence also why the thing takes as long as it does. What is the outcome of this? Republicans passed a skinnier version, but Trump, of course, has backed the House version of the bill.
Yeah, I mean, obviously, both there's complications in both chambers as they try to figure out how to accommodate what Trump says he wants. An extremely slim majority in the House, and obviously complications in the Senate, where a number of senators have to worry about either their own reelection prospects or have their own views that they feel need to be taken into account. And what Trump has been talking about really would obviously be a pretty significant restructuring, and there is a lot of deep concern over what kind of backlash that could mean for some Republicans as they have to start already turning their attentions toward the midterm elections in less than 2 years.
Kevin, thank you as always. That is Bloomberg's Brussels bureau chief, Kevin Whitelaw, who, of course, has an extensive background reporting in D.C. as well. Now, some corporate news for you. Shares of Nissan getting a boost in the latest session in Tokyo after a report from the FT suggested that a Japanese group has drawn up plans to seek investment from Tesla to support the firm. Those shares closing higher by 9.5%. Let's get more with Bloomberg's Craig Trudell. So, Craig, this firm might be drawing up plans, but is this something Tesla might actually do?
Yeah, the group here includes a former prime minister in Japan and also a former director on Tesla's board who used to run Japan's pension fund. So sort of on the surface with those characters involved, you have to take this seriously. But I do have to kind of wonder, just what the likelihood is that this gets as far off the ground as Nissan's attempt to combine with Honda got off the ground, which is to say not very far at all. When you sort of take a step back and think about, what Elon Musk would do if, put at the controls of Nissan, I think it's hard to fathom how, how Japanese factories and Japanese jobs would be protected given, what we've seen Musk do, not just in Washington of late, but also at his companies of late. Tesla, slash its workforce, globally last year. And this is someone who is a sort of ruthless operator. That may be what Nissan needs, but I think we've seen that Nissan's management and board is quite reluctant to do the sort of things that Musk would presumably want to do here.
Craig, we're also just getting some lines from Nikkei this morning that Foxconn has also proposed a partnership with Honda. When it comes to Honda and Nissan, how important is it that these companies find partners? How difficult will it be for them to continue on alone as it is?
I think Honda's a much healthier company and, is worth many multiples of Nissan. I think the question really is Nissan and its future and, whether or not if it can continue as its own company. We've seen, Moody's just overnight, cut their credit rating on Nissan. This is a company that, again, was trying to combine with Honda, and there were sort of culture clashes there. You want to sort of, again, go back to this FT story. If Nissan can't overcome culture clashes with a fellow Japanese manufacturer in Honda, you have to sort of wonder what the likelihood is that they could get along with Tesla and Elon Musk. But I do think that there are real concerns about the trajectory of Nissan, its performance, the state of its lineup, and that's really what you heard Moody's talk about in their downgrade. Was this is a company that its earnings power is severely degraded. The lineup is dated, and they have real issues in front of them in terms of trade policies. Of course, the Trump administration has long been hawkish on Japan and Japanese cars. That is, something that this company, can ill afford at this point, given the state of affairs.
Craig, I was going to say, is there's some degree recording Elon Musk is also a way to politically insulate themselves?
Yeah, I mean, I think that's part of what makes this FT report intriguing. The idea here apparently among this group of people who want to put these companies together is that Tesla could tap into Nissan's U.S. factories and add to its capacity. I think we heard saw from Musk in reaction to this report. He sent out this sort of cryptic post on X about the idea that Tesla's factories are its product, and I think the sort of easiest interpretation there is maybe Nissan's factories would not be of use to him if he sort of views Tesla's plants as superior and his production methods as superior to Nissan's. Perhaps he wouldn't have an interest in taking on this troubled company as a result of that.
Craig, thank you so much. Bloomberg's Craig Trudell there. Coming up, Francine Lacqua is going to be taking you through your day ahead. Next, I'm going to head over to the surveillance studio. We will see you shortly. This is your Bloomberg Brief.
This is Bloomberg Brief. I'm Francine Lacqua here in London, and here's a look at what's ahead today through the weekend. U.S. PMI coming in at 9:45 a.m. Eastern Time, followed by a revised reading of the University of Michigan Consumer Sentiment. That's at 10 a.m. Then more Fed speak from the Vice Chair, Philip Jefferson, at 11:30 a.m. And then, of course, on Saturday, Berkshire Hathaway reports its fourth quarter earnings. Now, a couple of things we're watching out for. Alibaba extending its post-earnings gains. Reported sales that beat estimates, driven by the core Taobao and Tmall business. Block also falling after fourth quarter results actually miss estimates, down some 7.27%. And finally, Rivian also declining after its results, given some of the downbeat vehicle delivery forecasts. These are what stocks are doing. The one I'm actually watching out for is probably gold. Gold headed for an 8th consecutive weekly advance. Again, this is amid all of these geopolitical and trade tensions. That's it for the Bloomberg Brief. Surveillance is up ahead. Context matters on Bloomberg.